The third quarter of 2025 has come to a close and the S&P 500 has performed admirably so far. Despite extreme volatility in early Q2, the market has bounced back. Since the low point on April 8th, the S&P has returned a remarkable 34.2%. So far in 2025, the S&P 500 is up a cool 13.7%. A solid run given the macro uncertainty that has generally beset the United States economy. And as we turn our attention to individual stocks, some have flourished in this current environment, while others have languished, frustrating investors. It is those languishing businesses that we'll discuss today. Are these 5 businesses headed for further turmoil, or is this an off year and there is real value to be had? Welcome to The Quality Investor. The S&P 500 is where I like to do my shopping. Longtime viewers of this channel know that I prefer established businesses with track records of consistent growth and compounding free cash flow. Winners are winners for a reason. And if we look at the mega caps of the S&P 500 defined as over a $200 billion market cap, we see that the median year-to-date return is 17.4%. The median large cap return, 5.4%. And mid caps, stocks with market caps between $2 to $10 billion, have a paltry median return year-to-date of negative 14.2%. The lesson here is that if you want to be the best, you must invest in the best. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. So, while some of these were once hot commodities, 2025 has seen them fall on hard times, at least from an investment perspective. On this video, we are discussing 5 of these S&P dogs. We'll look at their reasons for falling so hard in 2025 and then assess whether they can rebound and return to their high growth glory. The 5 businesses we are looking at today are FactSet, Chipotle, Accenture, Target, and Lululemon. All 5 of these businesses have performed quite poorly in 2025. Lululemon is the worst at a negative 53.5% decline this year alone, followed by FactSet at a negative 40%, Chipotle at negative 35%, Target at negative 33%, and Accenture at negative 30%. And even going back to the 5-year basis on some of these businesses, Lululemon, for example, you would have lost 12% annually if you invested 5 years ago today. Target, you would have lost 11% annually. And all of them are well off of their 52-week highs as well. So Lululemon is actually at 42% of their 52-week high. And on the other end of the spectrum, we have Accenture, which is at 62% of their 52-week high. All of them are trading near 52-week lows. And what else do we notice here? Well, we see that there's not a lot of real revenue growth here for any of these businesses. Now, this is at their fiscal year end, not on a trailing 12 basis. So on a 1-year basis at fiscal year end, Chipotle has grown at 14.6%. Lululemon grew at 10%. Target, however, is a loser of this bunch here, actually declining revenues on a 1-year basis at negative 0.8%. Margins themselves grown for both Chipotle and Lululemon, but have been squeezed a little bit for Accenture, FactSet, and Target. Now, free cash flow per share has been a little bit better. Chipotle and Accenture are both over 20%. Target even grew at 17.6%. So we're getting a little bit of revenue growth in some areas, but also we're getting some margin squeezing here. So let's dig into the individual companies and see what's going on. Starting with FactSet, when you look at it initially, it looks like it'd be a great business to invest in. We see continual growth in revenue and operating income and growth in the free cash flow as well, and they pay a nice and growing dividend. But coming up under the surface, we see why the market might be a little bit skittish. Their 1-year growth rate was 5.4%, and their fiscal year just ended on August 31st. So that's deceleration from their 10-year annual growth rate of 8.7%. And the same story with gross profit and operating income, deceleration of growth. And free cash flow only grew at 0.5%, well below their 10-year annual growth rate of 8.2%. Further, their fiscal year 2026 guidance was very disappointing. They are projecting revenues of $2.42 billion to $2.45 billion, which is only 4.5% to 5% growth. They're projecting revenues of $2.42 to $2.45 billion, which is only 4.5% to 5.5% year-over-year growth. Earnings per share on an adjusted basis, they projected at $16.90 to $17.60, which is flat to 3.5% growth. So well below what the market was expecting, contributing to this sell-off that we saw post-earnings of about 6 to 7%. On a year-to-date basis, they're down 40.35%, trading at $286.49 as of this recording, well off their 52-week high of nearly $500. But digging into the margins, you can see the gross margin has compressed over the years, now at 52.72%. Operating margin, on the other hand, has grown, so that's a positive here. But since fiscal year 2021, free cash flow margin has been declining, and the worst offender here is their ROIC, declining steadily over the last 10 years, now sitting at 25.4% for ROIC and at 19.2% for ROCE. Not exactly what we like to see. And if you look at the 10-year basis, the average ROC is at 42.8%. So they're not doing nearly as well generating a return on their invested capital. In fact, FactSet has indicated on the latest earnings call that it was macroeconomic headwinds combined with client budget constraints contributing to the dismal sales growth, saying that tighter client budgets amid the economic uncertainty have increased the scrutiny on their renewals, and that was particularly for their institutional clients. And of course, there's CEO speak calling it evolving market dynamics, which are curbing discretionary spending on data tools. The other interesting thing about FactSet is the market believes they're actually losing ground in the AI race against rivals like Bloomberg and Refinitiv. The company has been investing in AI-powered tools, but has been facing integration hurdles and client adoption, which is again contributing to a perceived vulnerability by the market. Essentially, the market doesn't think that FactSet's innovating as fast as some of their competitors. For me, the key for FactSet is, will their AI investments allow them to gain some ground here on their competitors and start accelerating both their revenue and earnings? And that remains to be seen. So until we see some real evidence of that, I do think FactSet will languish for a little bit longer and probably trade pretty flat for a while here. Chipotle has always been a model fast food restaurant. They're certainly positioned in the premium market when it comes to fast food. And to be honest, I really do enjoy Chipotle. I've gone there a lot. But let's see why the market is unhappy this year. We see that they have negative 35% return year to date. And the growth, at least on a 1-year basis compared to their 10-year basis, has accelerated 14.6% compared to 10.6%. It has slowed down a little bit here in the trailing 12, 11.6 billion in revenue, trailing 12 basis, compared to 11.3 billion. So we'll see how their fiscal year 2025 ends. And while their free cash flow has grown nicely since fiscal year 2016, it is lower on a trailing 12 basis here, 1.465 billion compared to 1.511 billion a year ago. But what we're seeing with Chipotle certainly is a severe slowdown in growth. And the biggest reason for that is, well, declining traffic in their stores. So their foot traffic has definitely been an issue. They saw a 4.9% drop in transactions in their most recent quarter, and that led to a 4% decline in same-store comps. And they only had a 0.9% rise in average ticket sales, meaning Chipotle doesn't have the pricing power that they used to. But what management said about this is that they're seeing volatility in consumer behavior, saying that amid the broader economic certainty that there's been persistent inflation and fears of an economic slowdown, and that is curbing the discretionary spending of its customers. And like I said, I think we've reached the peak of Chipotle's pricing power. They've had aggressive increases in prices of their food, up cumulatively 30% since 2021. And that has actually sparked kind of a backlash. So their traffic has eroded as a result of that. But I want to posit something else as to why Chipotle has been suffering. Now, I've been an avid Chipotle customer for years, but I would say the last few months, even the last year or so, it has been a disappointing dining experience. I feel like the restaurant's a little bit dirtier, the food prepped for you is a little bit sloppier, and for sure the prices have climbed pretty high. It just seems like the overall quality of Chipotle has gone down over the last year. And honestly, until they start improving that service, improving that quality of their food and the dining experience as a whole in the restaurants, I don't see Chipotle growing like they used to. They are expanding in Europe and the Middle East, so there is some runway there. And until that quality goes up, I think Chipotle will languish a little bit longer as an investment. Accenture is another business that looks pretty good on the surface. Steady, reliable growth in revenue, dividend growth is increasing, you have compounding free cash flow. But what we see here is that revenue growth really isn't all that fast. It's under 10%, 7.4% in the most recent year, and only 4.2% annually on a 3-year basis. They did have a nice pickup in free cash flow, 26.2% in their most recent fiscal year, which just ended on August 31st. But earnings per share growth, under 10%. Not something you expect to see from a business that does buy back shares and is growing their free cash flow. And similar to FactSet, it seems like the biggest reason for the decline so far this year is the fact that clients are hesitant to renew their services. Of course, Accenture is the largest consulting service in the world. I'm actually a former employee of Accenture, and I can tell you from experience, it's all about getting on that client, all about the next client. That is 100% what drives Accenture's business. And what we're seeing from Accenture is they're trying to pivot now to providing services in the AI space. And even when I was there a few years ago, and this was actually during 2020, 2021, before AI really became super hyped from an investment perspective, Accenture was really trying to get into the AI space. And Accenture just recently announced a sizable layoff of about 11,000 employees and cited re-skilling for AI as the reason. But as far as their performance, down nearly 30% year to date, it's another story of their performance and their guidance just not meeting market expectations. Their bookings guidance throughout the year was below expectations, which contributed to drops post-earnings throughout the year. And they're contributing that to the fact that inflation is rising and there's recession fears, which has prompted corporate clients to scrutinize the budget they have for consulting spend. And what we know about consulting is when there are fears around the economy or recessions are actively happening, the first thing businesses cut is their consulting spend. So it's kind of a luxury item in a way. So Accenture will certainly feel the brunt of that early. And they're also citing DOGE headwinds, the Department of Government Efficiency, which has slashed public sector contracts, a key revenue stream for Accenture actually. And this has helped contribute to their declining margins. We see gross margins down to 31.9%, operating margin down to 14.7%, free cash flow margin up a little bit. We also see that declining ROIC and ROCE. Still very healthy, 40.7% ROIC and a 25.5% ROCE, but down from over 10 years ago when their ROC was up at over 50%. But markets are always forward-looking, and until Accenture starts showing improvement in client retention and increasing those bookings, their stock will suffer for a little bit. And they are certainly shifting more towards servicing AI-type clients. And if that pays off for them, they'll certainly start to grow a little bit more rapidly again and probably be an attractive investment. But again, they have to show that in their earnings, which will take some time, but Accenture is a very strong business, and when they do rebound, it will be very positive for investors going forward. So as an investor, something to watch for Accenture is the increase in the client spending and acceleration with their AI type clients, and you'll know that they're on the right track as an investment. In my view, we are in the process of watching a slow motion collapse of a major retailer. Target is getting squeezed at both ends of their core demographic. They tend to cater towards more affluent households, middle class to upper middle class demographic. However, it seems they're starting to lose ground there to both Amazon and Costco. And then on the lower end of the spectrum, they are a discount retailer after all, they're starting to lose ground to Walmart. So they're getting squeezed out on both ends. And we see that reflected here in their charts here. Since fiscal year 2023, revenues declined each year, and on a trailing 12 basis, it's down again from fiscal year 2025. And their free cash flow basically flat to negative over the last 10 years. Their dividend increases have slowed dramatically. This is a business that is not struggling at this point, but slowly moving to that struggling territory. And their most recent quarter ended, their sales were flat year over year, but comp sales fell by 2%, which was driven by a 3.8% drop in their traffic. It was the third straight quarter of comp sales declines. And on top of that, management cut their full year guidance to flat to down 1% for comp sales. So things are not right at Target right now. And they cited persistent weakness in groceries and essentials, and they're seeing broader retail slowdowns. Although I disagree with that. Costco's up, Walmart's up, Amazon's up. it's Target that's slowing down. Now, Target CEO Brian Cornell, he even cited political backlash from some of their rollback of their DEI initiatives and boycotts because of that, claiming it contributed to a 2 to 3% decline in traffic in their boycott-heavy regions. I don't know how true that is, but they are saying that these social media boycott campaigns are resonating with their urban and higher income demographics, and it's exacerbating their slump. And of course, this has contributed to pretty steep margin decline. Gross margins down, operating margins down, free cash flow margin down, their ROIC and ROCE all declining heavily. This is a business that is trending in absolutely the wrong direction. But I have an alternate theory as to why they're declining so much. My view is they're getting crushed in the e-commerce business. Amazon and Walmart are both lapping Target on e-commerce sales, and that's ultimately what is hurting Target. They were slow to adopt an e-commerce platform, slow to adapt to what Amazon is doing. Walmart has adapted wonderfully to Amazon, and they've fallen behind quite a bit. So to give you some context here, Amazon owns about 37.6% market share in e-commerce, and they saw 8.6% year-over-year growth. Walmart owns about 6.4% of the market share and saw 22% year-over-year growth. These estimates are as of 2024. Target, on the other hand, only has a 1.9% market share. About $21 billion of their just over $100 million in sales is attributed to e-commerce, so about 20% of their sales. And they only grew their e-commerce by 0.8%. So they're losing ground right now in market share to e-commerce to giants like Amazon and Walmart, and that's off a much smaller base. So things are not looking good for Target. They're trying to drive their digital footprint by focusing on things like same-day delivery, but right now that's just not resonating with their consumers, and they're certainly seeing the decline because of that. Finally, we have Lululemon. Now, this is a business that was all the rage coming out of fiscal year 2020. You can see the run up in their market cap up to $57.2 billion at the end of fiscal year 2024, but is steeply declined since. On a trailing 12 basis, it was down to 23.8. It's currently at 21.1. Their share price has lost over 50% year to date, sitting at $177.93 as of this recording. And a big part of that is, you can see it here, 10-year annual growth rate for their sales at 19.4%. A marked slowdown to this past 1 year of 10%. On a trailing 12 basis, it's slowed down even more at $10.9 billion in trailing 12 revenue compared to $10.58 billion. Only 3% growth on a trailing 12 basis. This company has some serious headwinds that they're facing, and that's pretty much all reflected in their North American market right now, which is primarily the US. Their same-store sales fell 4% in Q2 of fiscal year 2025, so demand is certainly slowing for their apparel. And on a year-to-date basis, their comp sales only have grown 1%, which is down from 16% year-over-year growth in fiscal year 2022. And their biggest segment, which is women's apparel, has also been hit the hardest because of macroeconomic pressures and the shifting consumer spending habits. And of course, the Lululemon has attributed this to higher inflation, tariff concerns, basically the same things that we're seeing with Chipotle and Target, at least the reasons they're giving on the surface. But with Lululemon, my thesis here is that they're a fashion retailer. And when it comes to fashion, that stuff is notoriously cyclical. They simply don't have an economic moat strong enough to withstand a massive and extreme competition in this type of space. And primary competitors like Alo Yoga, Outdoor Voices, as well as, I guess, discount fashion retailers such as Shein, they've been capturing more market share now at lower price points. And I mean, that's translated into some margin compression here. You can see they're down on a trailing 12 basis of the gross margin, 59 down to 59.1. Nothing crazy there. They are down too on the operating margin and free cash flow margin. But what's really concerning for the market is they cut their full year guidance, both revenue and earnings per share, and that really spooked the margin. And that's going to pressure their margins a little bit more in the coming quarters. So all in all, the growth has been slowing down dramatically for Lululemon. I think that they've fallen out of favor from their core market, their core demographic. There's just so much competition in this type of apparel. It's tough for any business like Lululemon, especially given the rise that they had, to stay at the top for very long. A few years ago, it seemed like they were unstoppable. You saw their apparel everywhere. But as soon as something comes into the market that's just the same quality, even if the quality is less, it's not noticeably less, at a cheaper price, the market's going to shift that way. And Lululemon is certainly experiencing that decline. I don't think that they're going to go anywhere anytime soon, but the type of growth that they've seen maybe up until the last couple of years, I just don't think it's going to be there anymore. And this will become a very slow grower from an investment perspective.
Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.